Students, let us start with objectives of accounting. Now, accounting involves various steps. We have understood it in previous sessions. Now, what are the objectives that are to be catered to by the accounting process? The first objective of accounting is to maintain a systematic record of business transactions. That is, there are lots of transactions that take place with various dealers, with employees, with sellers, with buyers. So to maintain a proper record, that is to record them, to classify them and to make them available in a presentable form is what accounting's main and primary objective is. There is another objective of accounting which is very important and is actually linked to the objective of the business itself. That is to calculate the profits and losses of the business. Now we all know and we all understand that the basic motive of starting a business is to earn profits, and whatever we earn can be calculated through the process of accounting. Now this is a specialized step. It involves preparation of final accounts, that is in particular trading and profit and loss account. Trading and profit and loss account. These are specialized accounts that are prepared to calculate the profits and losses that we have earned in the business during a particular period. So we have understood two objectives. First one being to maintain a systematic record of business transactions, and then to calculate the profits and losses of the business. The main objective of the business is to earn profits. So we calculate those profits through accounting. And for this purpose, special accounts that are trading and profit and loss accounts are prepared. Then the third objective is to present the financial position of a business. Students, we must understand one thing. To calculate or to earn profits is something very different. And there is a difference in the financial position of the business. Very good businesses might make losses in certain years because of certain events or because of certain conditions. They might end up making losses, but that does not make them bad businesses. Take an example. Mr. X runs a business. The business has assets worth rupees 10 crores. In the previous year, he made a loss of 2 lakh rupees. Now, 2 lakh rupee loss in the previous year, does it make Mr. X a bad businessman? No. Probably because of fire, because of any change in economic conditions, he might have made that loss. But when you consider his previous track record, you will find that on average he was making a profit of 1 crores a year. Now since his average track record is very good, that means the business was good. The business has a sound financial position. It has huge assets as compared to its liabilities. 1 year profit and loss will not affect this business in a major way, particularly when it is a small loss. So any business should actually reflect upon its financial position, and that is done through accounts. For this purpose, a special business statement, what we call as balance sheet, is prepared. This statement gives a detailed account of the assets and the liabilities of the business, so that we can compare the profits and losses of business together with the financial position of the business. Now dear, next is it assists the management in decision making. Students, obviously management takes care of all the aspects of the business, but then there are aspects which require special attention. Let us take an example. A manager is actually considering buying a machine and he has two different options before him, and he is an engineer. As an engineer, he is well versed with the technical aspects of the machine, but he wants information from his accountant regarding depreciation, usage costs, and various other aspects which are financially related to that particular machine. So accounting is the tool that will supply that selective information which will help the manager in decision making process, right? So accounting provides the management with the necessary information and tools for making decisions in the business. Then students, accounting also provides information to the interested parties of the business. It provides information to other interested parties. Now, what are the other interested parties? Take a bank. You have taken loan from the bank. So bank would obviously be interested in the financial position of the business. Bank would be interested in whether you have the ability to repay the loan and the interest. So bank is automatically interested in your financial position. So that financial position would be conveyed to the bank through your accounting process or through the books of accounts.